All right, welcome back, Chart Addicts. Again, it's Roy Dunya, co-founder of Chart Addicts. There's been a lot of news in the media about FTX and about the bankruptcy and insolvency. So I want to make sure I did a video, broke down some of the facts and some of the things that everyone should know going into the next few weeks. Before we get started on this video, I want to let everyone know I've been a huge proponent of crypto for many years. And the only thing I get out of this story is that it's a giant stain on the industry, but it doesn't indicate the end of crypto, and it's definitely not Armageddon. And if you guys watch till the end, you'll get my 4 main lessons that I took away from this whole situation and how to avoid getting caught in something like this in the future. Also, side note, my voice is still shot because I'm still recovering from this recent cough, so I appreciate you guys' understanding on this. Let's go ahead and get started with this video. So one of the largest crypto exchanges in the world has just recently filed for bankruptcy. FTX was the second largest crypto exchange behind Binance, and they recently just filed for Chapter 11 bankruptcy following a series of liquidity issues at the exchange. So let's break that down and talk about what that actually means. Up until now, FTX was seen as one of the gold standards in the crypto industry, even bailing out some of the most notable names. The reputation has always been about leaning towards regulation and bailing out some of these distressed companies that have recently gone under this year and saving a lot of clients from losing money. Ironic. The head of FTX is a 30-year-old trader, investor, entrepreneur, and former MIT graduate named Sam Bankman-Fried. But just so you guys know, most people call him by SPF, and so for the rest of this video, you guys might hear those names interchangeably. We might use Sam and we might use SPF to describe the head of FTX. Up until this liquidity crunch in late October, Sam Bankman-Fried had a net worth of almost $26 billion, making him one of the richest people in the entire world. Before we get started on the liquidity issue and what's happening with FTX, let's break down who Sam Bankman-Fried is and see if we can understand a little bit more about his personal situation. Sam Bankman-Fried is the son of 2 very prominent Stanford lawyers and professors who are also very politically active. Sam was a graduate from MIT, so he's a very intelligent person and is obviously very well connected with his parents being very notable figures at Stanford. In 2013, when Sam Bankman-Fried graduated, he ended up working for Jane Street. Jane Street is one of the largest quantitative prop firms in the United States, and they deal with high-frequency trading, quantitative strategies, and other complex financial products. Sam Bankman-Fried got an internship and eventually a full-time job there trading international ETFs, and that was his introduction to trading into quantitative hedge fund strategies. Sometime in about 2017, Sam Bankman-Fried wasn't interested in being at Jane Street anymore. He went and started his own trading fund called Almeida Research. Almeida Research was basically a quantitative hedge fund that was focused on complex hedge strategies and complex quantitative strategies. And quantitative just means that they're using complex math and complex AIs and algos to do the trading for them, most likely to front run a lot of retail orders. So Bankman-Fried is said to have amassed a personal fortune at Almeida Research doing something called crypto arbitrage, which, if you guys don't know what that is, it's basically where you're buying crypto from one exchange and selling it on another. Typically, this happens when there's a difference in price between exchanges abroad and exchanges domestically. So you could potentially buy Bitcoin for $10,000 on a Japanese exchange and resell it on a United States exchange for $11,000. And if you did that regularly, you would be able to make $1,000 on that transaction. And if you're using a lot bigger capital and have more leverage, then you can typically make more money using these arbitrage strategies. Sam Bankman-Fried went on to make approximately $25 million a day in 2018 using these arbitrage strategies. So in 2018, through his success with Almeida Research, he took a lot of those funds and went and started FTX, which was meant to be a crypto derivative exchange. If you guys don't know what derivatives are, it's basically an asset that derives its value from another asset. So you guys can think about swaps, options, futures, and those are derivative contracts of the underlying security. So wheat futures, for example, are dependent on the actual wheat price. So since 2018, SPF has become one of the most famous names in crypto, making him one of the leaders in regulation and legislation in the United States, trying to push a lot of his policies through to give FTX the advantage in the crypto space. Since 2019, SPF has also gone on to buy $200 million of real estate in the Bahamas for him and his team, where he and some of the core team members reside, and has continued to buy property on the island as it becomes available. SPF also owns 8% of Robinhood. Granted, that's going to be in question during the bankruptcy filings, but since it's separate from FTX, he actually may get to keep that 8% stake. He's invested in tons of venture capital firms in the United States, a lot of which are still operational today. And oh yeah, did we mention that he's one of the largest donors to the Democratic Party? He was the second largest donor to Joe Biden's election in 2020 and has since donated hundreds of millions of dollars to the Democratic Party through PACs, super PACs, and other fundraising mechanisms. He's very politically involved, and in just a few short years of him running his fund, has become one of the largest political donors in the country, pushing a lot of his personal agendas. Let's go through the timeline of exactly how does the second largest crypto entity in the entire world go insolvent in the span of a week. Let's go down the timeline of events so we can understand what happened. Up until a week ago, this entire scam was still operational, and nobody really had any suspicion that the company was not solvent. The only reason that this became public knowledge is because the head of Binance, the world's largest crypto exchange, came out on Twitter the other day and basically called out SPF and their native token. Now, if you guys don't know what a native token is, it's basically a token that an exchange or a specific company created to help them with their internal operation. And so Binance has their native token, which is the BNB token, and that's something that customers use to basically trade in and out of different securities at a much favorable rate. It helps with the efficiency of a lot of the transactions on the exchange without having to swap into other currencies, which might cost you a lot more on an exchange. So they're a low-cost way to transact while you're actually on the exchange. Now, the problem with native tokens is that a lot of these companies have started to use them as collateral and have started to use them as a way to inflate the amount of assets they actually have. And so if you have a company and you just all of a sudden invented $50 million of this coin out of thin air, and a lot of people in the world bought into it, and now it's worth $20 billion, now you can convince a lot of people that you have 20 billion under management. But if this coin is not backed by anything, even though it doesn't really have any value. FTX had their own native token called FTT. So Binance was one of the early funders of the FTX exchange, and a couple years ago, they wanted to remove themselves from FTX. They ended up making an exit deal, multiple billions of dollars. The majority of the funds that were transferred were actually in the FTT token. And so the majority of the money that CZ, who was the head of Binance, received was in the form of this FTT token. And a lot of the money that was funding the Almeida research company, this quantitative hedge fund that Sam Bankman-Fried ran, was also funded with its FTT token. So these companies all had access and had collateral in this token that didn't really have a lot of value. Now, we're not entirely sure why the head of Binance came out and did this week, but he basically told a lot of people that FTX was up to some shady business and that he was going to be dumping his FTT token. Now, if your entire exchange, your research fund, and a lot of the loans that you've given out are in this native token, then you want that native token to remain healthy and you want the price of that token to remain robust. When your direct competitor comes out and says that they're selling your token, it causes a lot of market panic, and naturally a lot of people started to dump the FTT token. Now, when this token that is funding your operations starts to lose value dramatically, then your operations take a massive hit, and that's where problems really started for the FTX company. So basically that FTT token failing is the equivalent of like clearing the fog out of the entire industry, and everybody got to see exactly who was holding what assets and who actually had billions and who had make pretend billions with these made up native tokens. So FTX begins to suffer as a result and ends up going insolvent. Through the market panic and through a lot of the news revelations that are coming out, a lot of people end up withdrawing their money from FTX, and that's where the real problem started. So most exchanges, hedge funds, and institutions, if a lot of people try to pull their money out at the same time, it creates something called a run. So bank runs are typically when a lot of people try to take their money out of the bank at the same time and realize that the money isn't at the bank. Typically, when you give custody of your money to an institution like a bank or an exchange, they're now the legal owner of that money. And contrary to popular belief, the money doesn't just sit in the account. That institution typically takes these funds and goes to invest it or goes to re-lend that money so that they can continue to make profits off of your deposits. Now, unfortunately, the unregulated crypto space doesn't have any oversight, and so the way that this was done was completely fraudulent and ended up costing customers all of their money. So to get back on story here, a lot of people tried to take their money out at the same time and just completely collapse the FTX ecosystem. And even though we were in talks with FTX US about sponsoring our event next year, they ended up letting us know that they were not in danger and that they were completely solvent and ready to handle whatever it was. And I believed them, and I honestly believe that they had no idea that this was happening in the international arm. It's very important to recognize that FTX Global, FTX.com, and FTX US are two separate legal entities. And even though they bear the same name and they have the same bureaucracy, they are completely separate entities, and FTX US should have been safe from this contagion. However, because a lot of people started to hear the fear on social media, people started to withdraw their funds from FTX US as well, and that created another run on the US entity. So shortly after, FTX and Sam Bankman-Fried, they try to get on Twitter and social media, and they try to limit some of the loss and try to mitigate some of this risk. But ultimately, the day after, they ended up filing for Chapter 11 bankruptcy, and they were even supposed to get bought out by their number one competitor, which is Binance. So the company that was worth $26 billion just a few days ago had completely gone insolvent and had started to pause withdrawals. Most of the money was seen missing. The FTT token was now basically worthless, and the company was filing for Chapter 11 bankruptcy. Now, granted, Chapter 11 bankruptcy, just so you guys can understand, there's multiple types of bankruptcies that happen in US courts. Chapter 11 is basically just a credit reorganization from a company. So if you owe a bunch of creditors some debt and you start to fail as a company, you have to basically create a plan of action with the courts on who you're going to pay back first and how that's going to look. That's Chapter 11 bankruptcy. Versus something like a Chapter 7, which would mean that they can actually go into your accounts and dig some of this money out to pay back some of the people that you've hurt. Instead, the Chapter 11 bankruptcy is just a reorganization of debt, and so they're not fully going out of business, and the FTX name could still be around after this, questionably. So now that you're all caught up on what happened the past week, what exactly went down and where was the biggest problem? The biggest problem that was found was that Sam Bankman-Fried took money from people's accounts. And so the money that you saw on FTX was no longer available. They took customer deposits in order to fill some of the margin requirements in the Almeida Research Fund. The Almeida Research Fund has started to lose a significant amount of money. And even though it was a $15 billion fund, almost $6 billion of that was in the FTT token. When the FTT token started to fail, a lot of the leverage trades that they had started to unwind. You have to post enough margin to these brokers that you can keep these trades open. And so it's rumored that Sam Bankman-Fried took customer assets from FTX in order to solve a lot of the issues that were happening over on the Almeida side, and that created an absolute mess for FTX. It's also believed that the head of Binance knew that this was happening, and that's why he decided to speak up and ended up crashing the FTT token even more. Now, it's important to know that they were using very shady accounting practices, so it's almost impossible to track where all this money went, and it's even harder to track exactly where some of these client assets are. But as the company goes to court and some of these files start to become public, I think we're going to get a much better idea of what exactly happened with these funds and where was the fraud first. Now, if the story is already crazy enough, there was a $600 million hack of client assets on the FTX exchange one day after they filed for Chapter 11 bankruptcy. So you have this company who's already known for doing a lot of shady things with client funds and being fraudulent and potentially stealing client funds for their own uses. The day after they filed Chapter 11 bankruptcy, they end up having a $600 million hack on their client assets, which basically wiped out a lot of clients to absolute zero. Hacks are not uncommon in the crypto space, and whenever you're using an exchange, there's always going to be a risk that this exchange has some security protocols that are vulnerable to attack. FTX has a great reputation with security and privacy, and this was not something that anyone saw coming. And the sheer timing of this, the one day after they filed bankruptcy, has led to a lot of rumors that SPF and his team have siphoned off this $600 million for themselves before the proceedings and before things get really bad for FTX. Now, granted, there is no proof on this yet, but this is the leading narrative right now, is that SPF and his team had something to do with the $600 million hack, strictly due to the irony of the timing of this. So where is the FTX team now? Most people don't really know. It's said that they're still in the Bahamas where their headquarters are, but no way to really prove that. The Bahamian authorities have said that they're keeping a close watch on the FTX team and that they've created a lot of safeguards to make sure that people can get their money out in the island. However, it has not been verified that SPF is still on the island. There are some online narratives that he took his private jet to Argentina, and there's other narratives that he is currently trying to flee to Dubai in order to avoid any extradition laws and in order to avoid any of the tax liability. But it's important to know that the US authorities, as well as a lot of other international authorities, are currently looking for SPF, and they want answers on where the client funds were and an explanation on the abuse and misuse of these client funds. So are there any lessons to take away from this? Yes. If you're giving your money to a crypto exchange, understand that you're going to be taking a risk. When you give custody to a bank or when you give custody to an exchange, they are now the legal owner of your money, and you are now a creditor to this company. So if they go under, you're going to be somewhere down the line of people that are going to pay back, but you might never get your money back. It's very important that if you're involved in the crypto space, that you own the private keys to your coins. You're using a hard wallet and you are in full control of your money. If you're in full control of your money, you can't be hacked, and you're no longer exposed to the risk that a group of bad actors is going to take all of the funds. In crypto, we all believe in decentralization. And what decentralization is really trying to solve for is that when there's a central authority, that always leads to a central point of failure. If there's a group of people that can decide something, eventually they're going to have the opportunity to steal money, siphon funds, make bad decisions, or make fraudulent decisions, and they'll eventually be tempted enough to actually do that. The reason that I believe in Bitcoin so much is because it's decentralized and does not rely on a central point of authority to make any of these big decisions. And so the next time that you go to invest in any of these crypto companies or in any exchange, ask yourself, do they have a central point of failure? Is all the information stored in one central database? Are all the decisions concentrated among one central team? And if there's a central point of authority at any point in the process, it means that your crypto is at risk, some nefarious activity playing itself in. So lesson number one, central authorities lead to central points of failure. Lesson number two, exchanges are risky. Own your own coins, so if it's not your keys, not your cheese, not your coins, not your money. Native tokens might have some utility on that exchange, but they're basically an overblown Ponzi scheme. And so if you're holding too much of any one native token, then you're eventually going to be run into a risk if that token ever fails. And lesson number four, make sure to click like and subscribe if you guys found any value in this video, and I'll make sure to keep you guys updated as there's any revelations on this FTX issue. Take it easy, chart addicts. I'll see you guys in the next video. Peace.